Welcome back to the Williams Real Estate Channel. I am your host, Geordie Williams, and today we are discussing the RBA has increased the rate to 4.3%. So, the RBA, in its statement yesterday, had stated that CPI inflation is now expected to come back to 3.5% by the end of 2024 and to the top of the target band of 2 to 3% by 2025. The board believes that the interest rate rise was warranted to bring inflation back to the return to the target within a reasonable time frame, and the board remains determined to return inflation to the target and will do anything necessary to achieve that outcome. So it sort of alludes that there is potentially more rate rises on the horizon if inflation persists. So what do I think? Well, rates are still well below, well, not well below, but below the 30-year average of 5%. And so still relatively low in real terms. Also, they are still negative in real terms. So this means where you take the interest rate of 4.35% and you minus the inflation rate of 6 to 7%, it's still a negative rate. So this means that assets, so property, is still going up in value, and the value of the currency, being the debt, is also being devalued, and it's costing only 4.3%. So you're still ahead if you are holding property. Also, based off history and the 18-year land cycle, inflation will probably remain high, and interest rates will probably keep going up until the peak of the property market and until 2026, as we are now in the land boom. Now that rates are higher, banks are also earning higher profit margins, so they can now take more risks and lend more money into the market. So as banks are like any commercial business, when a commercial business makes more profit margins, they are still looking to expand their business, and banks do that by way of expanding their loan book. So now that they're making higher profit margins, they will start to loosen their lending policies and create more credit and lend that credit into the market to firstly expand their loan book, to create more business for themselves. And when they create more credit and lend that into the market, it will only drive property prices even higher based off history. That is how the land boom is driven. So excuse my painty fingers. I have been on my boat painting this morning. But so now we're in a good period. So when more credit is created, it will inflate property prices even higher. People are going to start speculating, I believe, in property over the next few years, and every man and his dog is going to be talking up property. We are now entering a similar period that we have seen last cycle, which was between 2003 and 2007, where interest rates, inflation, and property prices continued to rise concurrently. So if you look back at history, between 2002, 2003 to 2007, interest rates went up about 12 or 13 times, from a low of high threes, low fours, and they peaked in 2007 in mid 7%. So they went up a good decent, 100%, and so did property prices. And the reason for this is we are in a broad-based expansion. When the economy is strong, unemployment's low, people have jobs, people are making money, people are investing. It drives demand, it drives inflation. Therefore, interest rates are then used as a tool to bring inflation back down. So it is actually a good sign that interest rates are going up, because it shows that the economy is strong. So as long as you can manage your cash flow, which means your mortgage repayments, this is a great time to invest. However, this is not a time to be over leveraging yourself and buying $1 million plus properties with low rental yields of less than 5%. That is critical. Because if you want to stay in the game long term, this is not the time to be almost speculating in larger assets with low yields, backing that capital growth only, because interest rates will most likely keep going based off history. And if you can't meet your mortgage repayments with the low yields, well then banks won't take long for the banks to be recalling those loans. If you want to build a sustainable property portfolio and be able to stay in the game as rates rise, you must not be overpaying for property. If you are buying a property with a yield of less than 5%, you are, in my humble opinion, overpaying and putting yourself at high risk. So, what am I doing? No risk, no rest for the wicked. I personally never stop investing or taking action on my investments. So, I either by way of adding value, renovations, redevelopment, or acquiring sites. So I have my mortgage brokers on the go non-stop. As soon as they can get me money, I put it into the market. Again, by way of adding value to the portfolio, cleaning them up, renovations, kitchens, bathrooms, flooring, paint, adding secondary dwellings in the back to those that can provide such space and planning allows, and also continue to acquire when the opportunity arises in terms of both finance approval and the right property that suits my stage of investing. So only buy property with a 5% gross yield or more. Remember, if you are buying for capital growth with a low yield of 1 to 2 or 3%, in my opinion, you are speculating because no one really knows what the future holds. So if you are overpaying for property, then and backing that it's going to grow in value, pretty much speculating. So property is valued at 20 times earnings, generally speaking. So if you take a property's rent, annual rent, and you times that by 20, that will give you the value of the property. So that is basically a 5% gross rental yield. So if you are picking properties up for the 6, 7, 8, 9% gross yields, then you are getting property for under market value or under what the value is worth based off its earnings. If you are overpaying, if you're paying more for the property and therefore getting only 1, 2, 3, and 4% yields, you are overpaying based off the earnings of that property. So stick to 5% plus gross yield. Maintain a healthy debt coverage of at least 10%. So at least 10% of your debt you should carry in liquid that you could easily convert into cash. Ideally 20 to 30% of your debt, but minimum 10. So if you are a conservative investor and you have your liquidity in cash, have that in offset so you don't pay interest. Personally, myself, I have about 1% in cash and about 13 to 14% in blue chip stocks that pay higher dividends than I would be saving on the interest rate. So if I, instead of having the cash sit in an offset and saving myself 6 to 7% interest, I can put that into a blue chip stock that I earn higher than that in terms of the dividend, but then I also get the appreciation over time and the benefit of being able to sell within 2 to 3 days, convert it into cash and use it if I need it down the track to serve a higher holding cost. So continue to add value to the portfolio by way of renovations and small development to boost yields. and to continue to acquire property to build a portfolio. So my plan, I've got two plans, plan A and plan B. So plan A, ideal scenario between now and the peak of the market in 2026, I am going to continue to add value to the portfolio by way of granny flats and renovations to increase rents, manage increased loan repayments with higher cash flows. So ideally, I'm going to continue to move forward, build the portfolio out, increase the yields, and hopefully just sail through the storm of high interest rates. Continue to buy at least one property every 6 months, and then potentially sell cash flow poor properties. However, properties that have had higher growth. So I'm eyeing off two of my townhouses that I bought about 3 or 4 years ago to sell at the peak of the market to cash in 100% gain, if more, 150% gain, to then redeploy that capital into reinvest it into the portfolio and reinvest it into higher performing assets such as blocks of units once the market turns down the next land driven downturn, is my plan. So that's plan A. So continue to add value to the portfolio, and buying more property, and then potentially selling two of the less performing assets at the peak of the market, and then rolling the capital into higher yielding properties. Plan B, if interest rates keep going and it becomes a quite tough environment to, because obviously you got to stay in the game when you're property investing. It's not all sunshine and rainbows all the time. Plan B is I will burn through my debt coverage, and use that to cash flow the shortfall if I ever do get a shortfall. I personally pay principal and interest, so I would firstly hook them all back to interest only. Right now I cash flow positive with paying principal and interest, but if it gets to a point where I'm heavily negative, I'll firstly knock it back to interest only, and then I'll burn through all the cash. If I then burn through all the cash, I'll then look to sell underperforming lesser performing cash flow properties. So probably the two townhouses that I have, probably could sell them now for around the 270, 280 mark. I bought one for 152 and another one for 165. These are in and around Brisbane. So there's plenty of money in those deals now. So there's plenty. If I sold them, I could raise about 200,000 worth of cash, which would see me through the higher interest rate environment. But ideally, I want to try and hold them to the peak, because they'll probably be worth about 500 grand by the peak, in my opinion. So I'd rather offload them at the peak of the market for $500, 500,000 each. That's $1 million. Pay off 250,000 worth of debt, and then have probably pay another 100,000 in closing costs and tax. So have a good $600,000-700,000 worth of cash I can roll into a block of units, or potentially two, and keep moving forward and build a portfolio out. So that is my plans. That's my thoughts. No rest for the wicked. Keep charging ahead. Market's going to keep rising based off history. If you need help buying value property for under market value, under bank value, high yields across New South Wales and Queensland, hit me up. I'm always free for a chat any day of the week. Catch you next time. Hit the like button, subscribe, share. See you next time. Cheers.